Awesome. Well, let's get this thing rocking, Dave. How's it been?
It's been good, Paul.
You have a good day?
I did. I'm at an undisclosed location, so
You're I love it. And one of these days you're going to share that with even me.
you know, we laugh up here because all the guys who catch fish, you know, they show the picture of the monster fish and they submit it to the newspaper, but they'll never tell you where they caught it. It always says it was caught on a local lake.
Yeah.
And I'm like, oh, okay, yeah, we know. You know, I'm gonna have to follow you around to figure out where you caught that fish. So
Those fishermen, man, it's like their
we
pride
always
and
laugh.
joy.
Where'd you catch that? On an area lake. Where are you?
I love it.
Anyway,
I love it.
welcome everybody to our little evening here.
Hey, this is the fabulous Dave Forbes, the IBC. So, Dave, what do we got going tonight?
Well, I sent out the email about it. We've kind of been all over the place, and what I wanted to do tonight was get into a little bit about becoming your own banker. We always tout Paul's book, and because it's Paul's book, and we love to tout Paul's book. But we're going to go back to the source tonight for just a little bit, and just talk about becoming your own banker. And we may spend a couple of weeks on it. Want to talk a little bit more about the basics. Some of you are on here tonight are very familiar with the basics. Some aren't. But what we found is that you know, a little rehash of the basics never hurt anybody, including myself. And there's nothing better to learn something than to try to explain it to other people. And I'm going to try to do that in a succinct manner this evening. So
It's going to be epic.
anyway, can you share your screen with me, Paul?
Say again.
Can you share your screen? You got to turn off the host.
Oh, geez, I'm sorry.
Yeah, you
Yeah,
got one job. Yeah,
I missed that. I got the one job and I've screwed that up.
I know,
Okay,
so-
everybody, just bear with me on this deal. Okay, Dave, you got it.
Okay, thanks. I'm going to show my, okay. And stand by 1 second. All right. Can you all see that? How's that look?
Oh, it's a beautiful thing.
Yeah, okay. Anyway, as you all know, Nelson Nash wrote Becoming Your Own Banker 20 years ago. He actually started writing it in the late 90s, but I think it was published in 1999 or 2000. I have to go look in there. It's in its 6th edition. The 5th edition is the last print edition. There's a 6th edition that you can get on Kindle that has some updated changes to it and stuff. But it basically, it's a treatise that is more theory than fact in a lot of things. A lot of the examples he used over the years in the book haven't aged well, just because of the change in interest rates and some change in laws. But the overall idea of the book and the idea of the infinite banking concept is there, and it can sometimes be an easy read, or it can be a hard read, depending on how much you dive into it. And so when Paul and I were talking last week, we said, you know, we talk about Paul's book. I said, but you know what we need to do in a lot of cases, because we had some questions over the last couple of weeks that found that there's just some gaps in the overall group knowledge of what we're trying to do here. And so I thought, let's just take this one step at a time and talk a little bit about becoming your own banker and where Nelson Nash came in all of this and how he came to these conclusions and discoveries and everything else and started this. And those of you who don't know Nelson started out in the forestry business. He went to the University of Georgia, spent a little time flying airplanes in the Air National Guard, but his first job out of college was in forestry. He spent about 10 years in it. And he learned a couple of things. And he always used to laugh when he'd tell us, we learn in forestry, when's the best time to plant a tree? And the answer was 20 years ago. And when's the second best time to plant a tree? Well, it's today. And he used that philosophy when talking to people about infinite banking, because all of us, especially if we're over a certain age, who are just learning about infinite banking, look at it and go, why didn't I do this 20 years ago? Well, yeah, we all could say that. If we had the DeLorean, we could go back in time, we'd do it, but we don't. So when's the next best time to start is today. But his forestry origins taught him a couple of things. Compound interest over a long period of time is what you want to have. You want to have interest that earns interest. And you don't want to have any taxation on your buildup. You want that interest to grow basically tax-free and compound upon itself throughout your life. It requires long-term planning. Going back to what we were just talking about with should have planted the tree 20 years ago, what we want to do when we're setting up an infinite banking system is to think multi-generational. We want to set up a system that, while enhancing our financial future today, exponentially enhances the futures of our children, our grandchildren, and our great-grandchildren. And we want it to be in the sense that when we've graduated and we're long gone, and 3 generations down the road, when they are financially secure in a large way due to infinite banking, they'll ask their parents, hey, how do we get into this? And their parents will say, you know, Grandpa Paul got this thing set up, and I don't really quite understand it, but here's how it works within our family, and this is what the rules that we do this by, the infinite banking concept. And we hope by the 4th generation, it'll just be what they do. The Rothschilds did it, going back to the mid 1700s when the Rothschild family first came to power in Europe. They had an interesting plan, and their plan was that as they had a large extended family, as each member of the family went out into the world to seek his fortune, the family took out an insurance policy on that person. And that insurance policy didn't pay off direct descendants, it paid off the family trust. And then if they needed funds for that family trust, they borrowed from that to start their businesses. And over hundreds and hundreds of years, the Rothschilds ended up realizing that banking was the way to go, start and have been a powerhouse in banking for almost 300 years, still are to this day. They look at the cash value of insurance for what the power that it is. Another interesting example would be the Vanderbilts. The Vanderbilts did not believe in that. Cornelius Vanderbilt he was a billionaire in today's dollars and one of the robber barons they call, but he didn't set up the family for multi-generational planning. And when he died, there really was no succession plan for the money, and it was squandered over the next 2.5 generations. Vanderbilts actually got together a few years ago, I think it was almost 20 years ago, to have a family reunion of Vanderbilts at Vanderbilt University, and there was no millionaires in the group from that. Interesting. But anyway, long-term planning, and that's what we're always shooting for. When we talk about infinite banking, it's not a get-rich-quick scheme. It's a long-term plan. The magic of compounding interest is that the real results happen in later years. Those of you who've ever looked at an infinite banking illustration for insurance, you know, it really doesn't take off until about year 10, and you don't start seeing the real gains in your assets until after year 10 into year 20 and year 30. But what we want to talk about also is with infinite banking is the power of leverage. And I love this quote in Nelson's book. In the first part of the book, he says, real estate is not about real estate. It's about how you finance real estate. And how you finance real estate is the power of leverage. And you say, well, I don't have to finance it. I can pay cash for it. Well, if you pay cash for something, you're leveraging it anyway, because you are using that cash for that single asset, and you are losing the opportunity cost and the interest that it could earn at a later date or in another asset at the same time. And what he learned with real estate is real estate was basically using other people's money and leveraging it, because real estate is bought to be sold. And if you can buy the least money you can put into it, yes, you're going to have to pay interest if you leverage it and get a loan to pay for it. But in the end, you're going to try to sell it for more than you paid for it, plus the accumulation of your interest to make money. Okay. If you were to throw all your money into it and pay cash and just sit on it, well, you will get a capital gain at the end, but that money is just sitting there and can't be doing something else. The whole idea of infinite banking is to have a pool of money that is continuing to grow with compound interest that you can tap into to leverage other things. And that's where, as he's explaining early in the book, that's what he wants to try to get you to think differently about. And when we say think differently, it is to think of yourself as the banker and how you can leverage your money to do other things with your money, not just one thing, not just save it, not just spend it, but do other things. He had a comment in there in around page 10 that said interest is constant. And there's a lot of little things in the book that I'm like, I looked at that and I went, what is he talking about? Interest is constant. And then poof, the light bulb went off. I said, oh, whether you're going to pay interest, you're either going to pay it to the bank, you're going to pay it to yourself, or if you don't finance it, you're going to lose what you could have earned in the interest by having the cash just sit there. And you're paying the interest, quote unquote, in lost opportunity costs. And so when Nelson talks about interest is constant, that's what he wanted to impart into the reader, is that you always have to be thinking about the time value of money and how you can use the time value of money to your advantage, not someone else's. Nelson, and those of us who knew him personally, always would kind of with a chuckle and a twinkle in his eye say, you have to change the way you think about things. And I didn't understand it at first. I'm like, well, I'm understanding what you're telling me, but it literally takes a shift in your thinking and imagining what you could do if the circumstances were different. And when I say circumstances are different, if you weren't paying money to the bank, if you were doing X instead of Y, or you're locked into something, but something else becomes available, but you've got no way to imagine how to do it in a different way. And Albert Einstein said, imagination, it's a mother of all invention. And it is. It's more important than knowledge. We can understand interest rates. We can understand financing. We can have hour-long discussions over and over again about fiat money and the Federal Reserve. But what we have to do is we have to imagine in our own lives how things can be different if we change the way that we operate our own lives. And that is the big thing of becoming your own banker that really hits home, is it takes it on a personal level or on a family level of how we can change things, not for the world, but for ourselves. We'll start out small, and then we'll work on the 10% of everybody else to change it. We talked about mastering and understanding leverage. And a little thing I talked about there on the last slide I had, but what we talk about is there's two things with money. One is the volume of money. And think of a pipe, and money comes in and it flows out, and the more you make, the more you spend. Parkinson's law. There's a volume of money flowing through your life. Where is it going? Is it going right in one end and right out the other end? It could be. Or is it pooling and using that pool to shoot off into different aqueducts? That's the volume of money. And volume is exactly what we think about, in the sense that it is a X amount of money. But how do we make money with our volume of money? Well, we make it with velocity. How many times can we turn that money over and over and over again, using the same dollar over and over again? Okay, that is the velocity of money. And the magic of this is to take what you have in volume, change your thinking, understanding that you can do more with a dollar than just spend it or save it, and start the velocity going. So, when we talk about volume of money, how much of your money goes to bank interest right now? And that is a big thing. If you're not involved in an extreme infinite banking program, you've got bank loans. We all do. You got a car loan, you got a mortgage, you've got a line of credit, you've got a business loan. But But for the average, and I'm just going to use the average consumer tonight. The average consumer in the United States has in excess of 40% of all the volume of dollars that come in goes right back out to interest payments, to car loans, boat loans, house loans, lines of credit. That's a huge volume of money, 40% that could be diverted somewhere else or be used more than once. The interesting thing is I'm going to use in the book, Nelson used the water cooler example, is people are letting 40% of their salary or the money that's incoming go back out in the form of interest, and they try to save 5%. The average savings rate in the United States right now is about 5%. It varies. It actually went up a little bit in the last couple months, I think, because of the COVID, nobody's spending any money. So the savings rate went up to about 6%, I think, on a national level. 6% of every dollar is being put in savings right now. And what do people worry about? They worry about the interest rate on their savings accounts. Okay, 40% of their money's flying out the door, and they're worried if they're getting 1.25% or 1.5%, a 1/4% better rate on the 5% they're saving. It's so minuscule in the scheme of things. It's ridiculous, but it's what we've all been brought up to think. Oh, I'm getting a good rate. Okay, so things must be good. My $5 went in, and I'm going to get, basically, what does 1% of that come to? 5 cents at the end of the year. Right now it's 1%. And we worry about the interest rate in our savings. But what we need to do is change that thinking. We need to think of in the IBC system how we can take the velocity of money and turn it over and change and start pulling and chewing away from that 40% that's going out the door permanently to the bankers and bring it back in and be able to use it over and over again in our own lives. And that, my friends, is velocity. And velocity money is not doing only one thing at a time. We call it the and asset. You want your money to go in and be in its savings, which is our infinite banking policies. But then while it's sitting there, you want to go out and do other things with it. And then you want to pay yourself back and start the whole process over again, the whole time while that money is earning compound interest. What a lot of people don't understand is with the properly structured IBC policy is the money that is the cash value in your IBC policy. When you borrow from it, you do not borrow from the policy. We say borrow from your policy. That is a misnomer. What we're doing is we're getting a loan from the insurance company, from their general pool, and they're using your cash value as collateral. The money sits there and continues to earn interest. You get a loan. You're the best risk in the world for the insurance company because whether or not you ever pay it back, in the end, they're going to deduct what you owe them from your policy. Not what we want to do in infinite banking, but that's how the loan system works. You're not reducing the value of your cash value. You are taking money out from the general pool of the insurance company, turning around, using it and asset at the same time, paying it back and starting the process all over again. When Nelson talks about changing your thinking, he really wanted you to be thinking and asset, but always be thinking, what should I be doing next with my money? My money's sitting there, it's growing, but I can do other things with it. And if you're not of the persuasion that you want to be doing something else with it, or you just want to sleep well at night, well, there you go. It's going to sit there and grow, and you're going to sleep well at night doing it. So what else can my money be doing? Are there things I can do with it? Do I need a car? Is there an income opportunity? Dave, you talked about last week with us about the apartment that came available that you used your IBC policy for. And, that wouldn't have been available had you had to go out to a bank and get a loan and go through the whole process. And your money is still sitting in your IBC policy earning interest. And now it's over here earning a return on an income producing property. And that's what else should my money be doing? That's what we want it to do. Kind of following up a little bit, and I'm going to simplify things a little bit. Nelson loved to use the misnomer of the grocery store. Why? Grocery stores are something that we all use. We all have to eat. And unless we're self-sustaining farmers, we go to the grocery store and we buy food. And people who run grocery stores know this, and they have a wide variety. And the good grocery stores are very well run, extremely low margin. Here's our favorite grocer right there, Sam Drucker from Green Acres. I'm a Green Acres fan. Sorry.
I love it. I love it.
I can't resist. But anyway, a little bit on the grocery store. How do they really make money? How does a grocery store make money? Do they make it on margin or do they make it on turnover? What is margin? Margin is the difference between what you buy a product for and what you sell it for. That's your gross margin. Turnover is how many times you sell that same product over and over again. How many times you take a product in inventory, sell it, bring it back in, sell it. Okay. It's called inventory turnover. Businesses make their money not on margin, but on turnover. And I'm going to get a little bit deeper into this, and I may lose you, but we're going to use the dreaded can of peas. Okay. In the grocery store, the cost of a can of peas when it comes in the back door is 57 cents. Okay. And let's just say that Sam Drucker looks at it and marks it up 3 cents to 60 cents. So when you and I walk in the front door of the grocery store, we pay 60 cents for a can of peas. How much did Sam Drucker make? 3 cents. Okay. That's his gross profit. Okay. How many times does he have to sell that can of peas to actually pay for that can of peas? That's called turnover. Okay. What we want is we want to make 3 cents over and over and over and over and over again till we get to the cost of a can of peas and make our first 3 cents of profit. So how many times do we have to sell a can of peas to make money? Not once, not twice, but 20 times. 20 times 3 is 60 cents. And there's our first profit. So the trick is if you know what your turnover rate is, guess what happens? At the 21st inventory turnover, how much profit does Sam Drucker make? He makes 60 cents on the 21st turnover. So there is the velocity of money. He's turned it over and over and over again. And if we can imagine an IBC dollar being a can of peas, and we turn it over and over and over again, we finally get to a point with the compounding interest added in that we are at our 21st turnover, and our dollar is making us way more than $1 every time we pull it out to do something. And that's what we want to do. But there's a trick with owning a store. Sam Drucker has a wife, and Sam Drucker's wife comes in the back door and says, wait a minute, we own the store. I don't have to pay for peas. I'm just going to take them home. Well, you've just removed a 57-cent item from your store that took 20 sales to pay for. So now how many inventory turnovers do you need if you steal the can of peas out the back door? You're going to need 40 turns. It's not just one, it's 40. So the trick is, and when we talk in IBC about stealing the peas, and we love to use that misnomer, is as an IBC becoming your own banker, we borrow the money, but we pay it back at retail. We're paying it back into the mutual insurance company. The money goes into the pool of money that then gets, if there's excess at the end of the year, which there usually always is for the last 100 years or so, it gets distributed to us in dividends. Okay, but we're paying retail. And here's the magic of paying retail is it forces you to be honest with yourself about how you are managing your money. You're not stealing the peas you're paying up front. You're paying 60 cents for your can of peas. If you steal from yourself, you're just hurting yourself in the long term. You're hurting your long-term returns. Remember, when we go back to our forestry example, your real returns are shown at the end of this process. As the years go on and that yield curve starts to climb, if you haven't paid back your loans, you've still got an internal liability out there that, yes, will be paid off, but it's hurting your future returns. So you don't steal from yourself. And actually what Nelson recommended was you pay yourself back at a higher rate. Pay yourself back at 62 cents. Because guess what's going to happen? 62 cents, 62 cents, 62 cents. And all of a sudden, your inventory turnover doesn't take 20 times, it takes 14 times. And that money is back in velocity, and the velocity starts to increase. But it's a long-term process. You have to start out small and build and build and build and manage it in a responsible way. The higher internal rate, the 62 cents, as I say, gooses your compound interest, and it does. And I like my graphic here because it basically shows that you're running away. You think you're running out the back door with all your P's, and all you're doing is just shedding dollars out the back of your bag. Make sense?
Absolutely.
All right.
That was awesome.
So the whole point of this, and what we're going to do is I'm going to pick up in the book next week, or if we have something more pressing, we'll skip a week. And we're going to talk more about what happens after this and how we get into nuts and bolts. Nelson's book doesn't get in, he uses examples, but it's more of like I said, a changing of your thought process of how a dollar's going to come in, but what am I going to do with it? Am I going to just give it to the bank, or am I going to devise a system with the help of an IBC practitioner that will allow me to recapture debt, recapture all this, and basically the only debt that I have after X number of years is going to be debt that I take on within myself, within my IBC system. So.
You know, one of his favorite quotes, Dave, that was awesome. Thank you.
Thanks.
That was really, really good. And
well, yeah, I'm trying, you know, I love this system. I just wish, Paul, and I'll let you on your quote though, but what I really loved about Nelson, was he was one of the kindest men I've ever met. And and he was the only 88-year-old man that would frequently FaceTime with you and yuck it up, but he'd have his little white earbud in his ear and chatting away. But he never really talked about specifics unless you asked him about specifics. He would always talk to you about, no, you're not thinking that through right. You need to change your thinking. He said that, I mean, Paul, you know, how many times in your life has he told you to change your thinking? And you would say,
all the time. Every time you're around him, he'd say that.
I know. And that's the one thing that I want to help us press on is exactly that, you know, we have to work at changing our thinking. And going back and looking at his book and just kind of doing a deep dive into it and talking about it helps us all in the long run, because it just allows us to get the foundation in here.
Absolutely. It's a must to read that book at least once a year. And if you read it more. Yeah. I mean, it's been years since we both have been involved with IBC, and you know, I can go back to that book and I'll see stuff that I hadn't seen before, and I'm just like, God, that guy was so far ahead of his time.
Oh, yeah. And I actually took mine. I took it over to Office Max and had it spiral bound with plastic covers on it, so I could just
last forever.
And I could mark it up and do things. And
absolutely,
I'd love to show it to you, but my bride is reading it out in the gazebo right now because I left it out there. So
awesome. Anyway. I love it.
All right. Anyway.
Well, hey,
what else we got?
Oh, I don't know. Does anybody have any questions tonight? And if you do, you can take your mic off, or you can type it out if you don't want to talk.
I appreciate the overview. That was a nice job giving the foundational overview. So well done, David.
Well, thanks, Mark. I just you know, it's interesting. The first time I saw that in a live presentation from Nelson, when he said, "Don't steal the peas." And it didn't really sink in at first. And I had been in retail. I mean, before that, and, you know, you talk about inventory turns and you learn all the accounting processes for figuring how many times you've turned your inventory and everything else. And it was like the light went off in my head. I'm like, oh yeah, in my own life, that dollar has got to come back around and around and around again. And the faster it goes, the more it benefits me. So thanks.
Hey guys, I have a question if that's okay. I jumped on a little bit late, but I'm glad to be here and I appreciate you guys. I wanted to know a little bit of the construct of a policy. I once talked with Paul about some people pay for the entire yearly premium up front. Is it possible for people not to pay for the premium up front, or can they put X amount down? I don't know anything about the terms, I guess, of a policy or how you construct it, and I'm wondering how, you know, we create each one for each individual. I'm just wondering what the parameters are, or what are we shooting for, or how flexible are people? Again, I'm kind of rambling on. Do people just put their paycheck in there and withdraw money? Or what are the options that you've seen? That is a pretty broad question, but I'm pretty new, so I'm looking for a broad answer.
Yes, you can do all of that, Andy.
How's that? Yes, Andy.
All right, see you later.
All right, meeting's over.
Oh my gosh, that was great. Oh, now you know why I hang out with Dave so much. Yeah. But Andy, there's a lot to discuss within that long question of yours. You hit on a lot of different topics. The cool thing about IBC is there's a ton of flexibility, and you know, infinite goes a long way with this whole concept. You have flexibility in how you want to pay, how the policy is designed, how many years you want it to look. You know, I mean, it just goes on and on and on. And to be able to answer your question in one, like, 2 or 3 minute segment is way beyond the conversation.
Right.
But certainly our hope here with this Monday night meeting is to share all these topics and help you, the end user, or the prospect, to better understand how this thing breaks down. But it really is it's just infinite. Dave, I mean,
well, right. And Andy, what you were talking about is, you know, we laugh and say, yes, meeting over, but it's true. What happens with a policy is you set up a policy. We figure out the best, you know, we sit down with you, do the deep dive on where you are in your life, where you want to go in your life, what the plan is. When we make a plan, and it's a very global plan. It's not specific to policies. It's to what kind of debt do you have? What kind of income? Where do you want to go? I want to have my house paid off in 10 years. I want to buy a car every 5 years, whatever. I want to pay for my kids' college.
I understand.
At that point, we say, okay, let's start structuring this. And policies, like Paul said, can be structured in a variety of ways. There's annual premiums, quarterly premiums, monthly premiums. We can front load in the first year a policy if there's a windfall of cash that you want to, as I said in my slideshow, goose your policy a little bit to increase your cash value in the policy. Some people want that cash value from day one. So they go on annual premiums and they say, okay, I'm in here on February 1st every year is my policy. I'm writing my check, and that will then earn dividends for that whole year. Other people say, I'm on cash flow. I'm just starting out. I'm just getting this thing going. This policy's got to be a monthly thing for me. It needs to be like my car payment. And they set them up that way.
Sure.
They're very, very flexible. The only difference is as you are looking, if you're looking at where your cash value be, like a monthly premium, your cash value is going to grow a little bit slower because you're adding it in throughout the year versus
I understand.
an initial payment. But
how then would your cash payment, if you will, or deposit, match to the term, how does that compare then to the death benefit? In other words, if you started out with a $20,000 policy, in other words, you put $20,000 down, is the death benefit correlate to the yearly premium or the initial amount down, or how do those two relate?
Again, that's a deep dive, but
sorry.
I will say
that's good.
No, they're great questions, and I'm glad you're asking them. And believe me, we're not trying to avoid answering any of this. It's just, you know, how do I start answering something like that and make it and answer it in, you know, just a 1 or 2 sentence succinct response. But there's 2 pieces to the annual premium / deposit. Okay. And of those two pieces, that's what determines what the death benefit is right out of the gate in year one. Okay. So it matters not how the annual premium deposit is made, whether it's monthly, quarterly, or once a year, because the death benefit is going to remain the same. What Dave was alluding to, and he made a really nice point, is the cash value as you move forward in time. If you start out on a monthly basis, really limits your infinite banking system, so to speak, because what you're trying to do is just shift get all of the outgoing interest, for example, and redirect it back into your system. So you want to keep it inside. So, I hope that helps you kind of see that. But the death benefit, as it's presented on the illustration, when you first create it and dial it in, I mean, it's the same, and it just, both sides, the cash value and the death benefit, both grow year after year after year.
Okay, I get it. Yeah. Thank you, guys.
Yeah.
And Andy, just to add to that real quick, just to kind of give you more of a bigger picture of it, also, every year you do receive a dividend, and those dividends are quote unquote reinvested, where a portion of it goes to your cash value, but another portion of it also goes to buying insurance. So the death benefit in the infinite banking concept system does grow over time. Your initial policy, when you set it, depending, and that deposit is dependent upon age and health and all these other things, but your death benefit is set and locked in. It's a contract between you and the insurance company that, when Andy graduates, it's going to pay out X, whether that's tomorrow or 50 years from now. Okay, but then the machinations of the infinite banking policy start, and as you contribute more money into it, it buys a little bit of insurance, it buys a lot more cash value, and blah, 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 and as it grows. So in the illustration does show that. And so at the 20-year point, it looks very different from day one, obviously, in terms of both cash value and the amount of death benefit that you have.
Okay. All right. I like it. Thank you.
Sure. A very long answer to a long question.
That's awesome. Awesome.
All right.
Well, anybody else?
It's okay. My apologies too for taking 2 weeks off, you guys. We took 2 weeks. We took a week off for Memorial Day, and if any of you have been to the Financial Prodigy website recently, thefinancialprodigy.com, you'll see a new website. Paul and I have been working with a really nice gal who's been helping us a lot improve the look and feel of our website and some other things. And we were kind of up to it in our elbows last Monday afternoon. And we looked at each other and went, we can't do this at 7 o'clock tonight. And so we just canceled all the emails and didn't do it. So our apologies. We'll be better going forward.
But we both are really happy with the way it turned out. And, if you guys have time, just go to thefinancialprodigy.com and check it out, roll down. And we really want to know what you think of the video on there. That was
his name. His new name is Paul Spielberg. It's,
yeah, well, I think it was a team effort. That's the way I look at it. Yeah. So anyway, all right. Well, if no,
what's that, Mark?
What's your target? What are your goals? What do you want to accomplish with the new website?
It's a little, well, obviously
education
to tell people who we are and what we're doing. But it's also to introduce people we come in contact with infinite banking. And it's a lot of education. We're trying to develop it as a resource I put these Monday night talks, I rip them and edit them and put them up on YouTube, but I also put them onto our website if you don't want to go to YouTube. But the other thing is we put up Nelson Nash's bank notes. I think Carlos Lara told me I can start posting the Murphy Lara reports on there. He's got to give me, and it's just more infinite banking stuff from other sources and kind of become a central hub, Mark, is what we're trying to do. I mean, there's not a whole lot of sales on our website. It's more of what we do. And if it strikes your fancy, there is a place deep down in the website to schedule a call with Paul or I, but it's not really the purpose is education. It's all education.
Cool.
It's not very complex. What is it, Paul? 6 pages, 6 web pages? Yeah,
Well, you don't need it. I mean, you get too complex and everybody, you got to be easy. That's why my book is only like 120 pages long. I mean, you don't want to look at something and go, I'll never learn the system.
Right.
You got to make it easy. And this system is so easy. It's just that you got to make that paradigm shift from one side to the other because you've been taught one system, believe it, and they're screwing you royally. 100%.
And as time goes on, Mark, you asked, our whole goal is to take this forward for the core group here that tends to show up every Monday night and become more and more advanced as we go. The whole idea is these more basic ones, as I start on Nelson Nash's book, we're going to put those up. And if you need beginning remedial training, go look at the June 8th, Monday night, Money Monday. The September 12th Money Monday might be far more complex with a lot more complex questions. At least I hope it will be. That's kind of our goal in this as we go forward.
Yeah. Very good. Very good. Thank you.
Sure.
Well, thanks everybody for joining us tonight. We'll hope to see you all next week. And, feel free to share this with your friends because that's what we're all about, right?
That's right. All right, everybody. Thank you for joining us. I appreciate it.
Have a great night.
Good day.
Bye-bye.